Japan raises rates to 31-year high to ward off war inflation, and that headline tells you almost everything you need to know about the kind of world we're living in right now. On Tuesday, the Bank of Japan announced it would raise its benchmark interest rate by 1/4 percentage point, bringing it to 1%. That might not sound dramatic, but 1% is the highest Japan's rates have been in 31 years. 31 years. This is a country that spent decades at near zero, even negative interest rates, so this move is genuinely historic. So why now? The short answer: the war in the Middle East. The closure of the Strait of Hormuz has cut Japan off from the Middle East, which is where about 90% of its crude oil comes from. 90%. When that supply gets disrupted, you feel it in everything: fuel, food, the plastic packaging around your lunch. Businesses across Japan had already been bracing to raise prices because of shortages of naphtha, an oil byproduct used in industrial inks, plastics, and a whole range of everyday goods. The Bank of Japan looked at all of this and decided we need to act before the inflation wave hits, not after. And that lesson comes directly from 2022, when Russia invaded Ukraine. Back then, the European Central Bank called inflation transitory, held off on raising rates, and watched Eurozone inflation blast past 10%. The ECB paid dearly for that mistake. This time around, both the ECB and the Bank of Japan are moving fast and early. Central bankers, as one Barclays economist put it, learn from the experience of 2022. But here's where it gets politically interesting. Japan's Prime Minister Sanae Takaichi, think of her as Japan's version of a low-interest, weak currency hawk, did not want this rate hike. A weaker yen helps Japanese exporters by making their goods cheaper abroad, and her whole economic agenda depends on government spending that becomes harder to sustain when borrowing costs rise. She's been a vocal opponent of rate hikes since winning election last October. And yet the Bank of Japan went ahead anyway. Why? Because the pressure from outside Japan became too great to ignore. The yen has been sliding past 160 yen per dollar for the first time in nearly 2 years. Japan's finance ministry spent tens of billions of dollars trying to prop up the currency with limited success. And then in May, U.S. Treasury Secretary Scott Bessent flew to Tokyo and made it pretty clear the yen is too weak, and the Bank of Japan should be free from political pressure. According to economists at Barclays, the Prime Minister still privately believes in a weak yen and low rates, but with the U.S. pushing back and the currency in free fall, she had, quote, no choice but to passively accept it. The markets, for their part, took the news well, at least initially. The Nikkei 225 surged above 70,000 for the first time ever before pulling back and closing slightly higher. And there is one piece of good news in all of this: the U.S. and Iran have reached an agreement to reopen the Strait of Hormuz, which should provide some relief, though economists still expect war-related price pressures to show up in Japan's data this month, with supply chain strains likely persisting through the end of the year. The bottom line here is simple: Japan just made its boldest monetary policy move in a generation, not because it wanted to, but because a war, a sinking currency, and a phone call from Washington left it with no other choice.